Okay, I think we can start now. So, just to introduce myself briefly for attendees, my name is Patricia Zivkovic. I'm a lecturer in international dispute resolution at the University of Aberdeen. I am also a member of SCOTLIN, and it is my pleasure to be today to open this enlightening talk um, uh, on behalf of the network. Before I give the floor to Dr. Jahon Chen, who will be the moderator of today's talk, and to our speaker, who will talk about the topic that you can see on the screen, the invisible mind within the black box, Israel Cedillo Lazcano, I would just like to mention that these talks are funded by the funding that was awarded to the network by the Royal Society of Edinburgh, and also that this talk will be recorded. I would like to encourage all attendees, and I'm sure that Dr. Jahon Chen will mention this once again, to ask questions about the talk. We are here to spark a discussion and to deal with interesting and sort of controversial topics in the field of IT law. So if you have any questions, feel free to ask. Without further ado, Jahon, please take over, and I will come up at the end to announce the talk that will take place next.
Yeah, thank you very much, Patricia. I think Patricia has done an amazing job introducing both the panel as well as introducing how this works. So I don't really have a lot to mention before I let Israel talk. But just one thing that you might want to keep in mind is I think the Q&A section is open now. So if you have any questions, you can put it there at any point. You don't have to wait until the end of the talk, and I'll collect those questions after Israel's talk, which will last around 20 minutes. I might take the privilege as the moderator to have a little bit discussion with Israel first, but then the floor will be open to everyone. So yeah, I'll just hand over to Israel. The floor is yours.
Thank you. Thank you very much, Jahon. Thank you very much, everyone, for being here to discuss this, I think, a very fascinating topic. It's a work in progress, as some of you already know. It will be part of a book that is coordinated by Professor Indrajit Dubey on the governance of AI in companies across different sectors. I'm working on the financial industry in particular. For me, it's a pleasure to be here. Of course, I always have Scotland in my heart, and when Guido invited me to take part in this group of Scottish researchers, to foster Scottish research on these topics that fascinated us, I couldn't refuse. Well, in the presentation of today, we are going to talk about the invisible mind within the black box. That in few words, I will take the analogy, and I will work around the analogy of the invisible hand developed, or better said, introduced by Adam Smith in several works that tend to be related to different elements of human rationality with human intelligence. So these both concepts, the invisible hand and the invisible mind, are closely related with human intelligence to different levels, as we are going to see today. But it's very important in the context of financial markets. And before exploring this extrapolation between the concept of the invisible hand and the invisible mind, I would like to set a couple of things, introductory things, to put in context the discussion. First, financial markets work in a very dark way, shadowy way. Actually, that's why we have even shadow banking, that is the innovative force that is behind our financial markets. Even Alan Greenspan, after the great collapse of the great financial crisis between 2007 and 2009, he had to acknowledge that financial markets work in a very shadowy way. And in certain way, that is one of the elements that will define the financial markets. For example, there are no more than 10 persons that understand how a derivative product works perfectly. So, and that's why this market works a lot with asymmetries of information. And these asymmetries apparently after every great financial crisis tends to be more complicated. And one of the elements that I want to highlight today is that probably the next GFC, the next great financial crisis, could be the outcome of operational malfunction related probably to AI. Some people say that blockchain is the future of financial markets. I do not agree, despite that I work a lot on that topic, on that subject, particularly in my PhD thesis. But I think that the most risky element that probably will be behind the next great financial crisis is machine learning, to be more specific. And we are witnessing some ground to the emergence of some ground for these risks. For example, the use of artificial intelligence in financial markets is not something new. And actually, we have experienced some failures related to the malfunctioning of algorithms. For example, on May 6, 2010, we had the very famous flash crash in which the algorithms failed to determine certain prices, and they sold a lot of assets, a lot of securities on an unsupported assumption, okay? And these algorithms acted in a certain way, like in a tacit collusion, and they took the entire market for less than an hour to a standby, because they took the value of the entire market close to zero. So the SEC, together with other regulators, they start to work on which were the reasons, the causes behind this flash crash. And one of the main discoveries is where these algorithms that were automated on an automated way, they were selling securities under signals that probably on an interaction between humans will be held on a rational way. But we have faced in the past collapses, failures related to artificial intelligence, and certainly we are going to witness, particularly in our context, when we are talking about fintech. Everyone is talking about the beauties, the potential of fintech, but fintech in certain way is opening the gate for artificial intelligence to the entire financial sector. And I am not talking about that we are going to see fintechs focused exclusively on offering financial services based on artificial intelligence. No, the thing that worries me the most is the provision of infrastructural power to commercial banks, to central banks, to funds, to other shadow banks that are systemic relevant, okay, that will be working with these developments. And I put this graph on the screen because I think that is something interesting to see. For example, we are based on this Google Trends chart. We see that the term fintech and all the elements related to fintech starts to have a boom. They start to diffuse around 2015. And there is no coincidence in this, because 2015 is a very important year for artificial intelligence, because in 2015, as it has been explained by several authors, we start with a new spring of the artificial intelligence through the diffusion of machine learning. So we can see that machine learning and the fintech industry is growing together, mainly because there is an interrelation between fintech and machine learning, because machine learning is the core of many of these fintech functions, of these fintech applications, and of course, of those fintechs that want to be part of the infrastructural power of commercial banks, of central banks, insurers, among other financial intermediaries. Okay. However, the story is, despite that we have this potential, that certainly is a very interesting potential, a potential that we cannot discard, we have risks. Okay, because we are evolving, or as we have seen from this flash crash and the growing relevance of AI, machine learning in the context of the financial industry, we are making a transition from the invisible hand to the invisible mind. Okay, now, why is this relevant to highlight? Because this invisible hand is become automated on an artificial way. And why? Because invisible hand, as I mentioned in the opening of this session, is based on the conception of human intelligence and rationality. Okay, and within the financial sector, we have two schools of thought. One led by authors like Eugene Fama, Milton Friedman, that say that financial markets are efficient that all of us, we are intelligent players, that all of us, we have perfect information, and based on the outcomes that we want to pursue, we will take the best decisions based on our rationality and based on the perfect information that we have. While on the other hand, we have authors like Hyman Minsky that say, or Robert Schiller, that said, no, we are not different from other mammals. We are subject to fear, we are subject to greed, and of course we cannot code that. Okay, because we cannot, from a starting point of view, we could say, okay, we have the technology and we can code the behaviors that Eugene Fama and Milton Friedman are stating. Because in that way, we could have a perfect technology, that a neutral technology that will take the better decisions based on the best interest for us. However, just as we see in other sectors, in other industries with biases, we will have a wide offer of biases, not all of them rational, with a rational basis, because sometimes we are going to have fear, greed, different preferences, even different approaches to what a financial market is, and even different approaches about what money is. Okay, so, and if we cannot code that on an optimal way, we are going to face operational risks, particularly when we are relying on an industry, I'm talking about machine learning, talking about artificial intelligence, that relies on global value chains, in which we are going to identify, or better said, we have to identify different infrastructures and different stakeholders that go beyond the simple bank. Because sometimes we say, okay, this bank is employing machine learning, this bank is employing artificial intelligence, but probably they do not have the proper control of the entire infrastructure. We have other stakeholders that control those infrastructures. And this is not something new in the context of financial markets. For example, credit and debit cards, they rely on the infrastructural power of non-financial companies, for example, MasterCard and Visa. They are not financial intermediaries. They are telecoms. They are regulated as telecoms. Okay, they are infrastructural stakeholders that provide a service to financial intermediaries. Okay, and as we can see, it's not something new, it's not something that we have to avoid, but we have to be aware that there are risks related to the control that several stakeholders have, particularly in our technology that can be defined to be a market imperfection by itself. Okay, because when we are talking about artificial intelligence, when we are talking about machine learning, we are not talking about this dream that everyone is stating that, okay, we are going to have this perfect technology, this neutral technology that will execute all the orders and will follow the ideal of Eugene Fama and Milton Friedman. No, artificial intelligence and machine learning by themselves are market imperfections, not market failures, because we are not waiting in artificial intelligence to fail. They will fail, they are failing. They are market imperfections that will be defined by market power, information asymmetries, and externalities. In the part of market power, we have that only few companies around the world have the power to develop a proper neural network, a proper algorithm that can execute, that can fulfill the outcomes that we want to see within central banks, commercial banks, fintechs. Okay? Of course, if we are going beyond expert programs that also are covered within the Artificial Intelligence Act. And for that, and from this market power, we are going to foster information asymmetries, because only a bunch of people know what is behind these algorithms, and sometimes even they do not understand fully what happens when an algorithm takes a decision. Because, for example, in the case of the flash crash, given that it was based on an expert program, it was relatively easy to determine where the mistake, where the failure was located in. Okay, because the only thing that we had to do was to repeat the instruction, the order, to identify where the failure was being executed. But in the case of machine learning, for example, what happens if I cannot identify through repetition where the failure is? I will have an information asymmetry that will complicate, okay, of course, paired with trade secrets and NDAs, among other things, to complicate the decision taking with full information, with complete information, as Fama say. Okay, of course, sometimes in the market we are going to say, okay, we are working with machine learning, we are working with artificial intelligence, but sometimes, most of the times, we do not know what we are talking about, particularly customers and non-sophisticated investors. And of course, together, market power and information asymmetries will unleash externalities, of course, both positive but also negative externalities to our financial systems. And within our financial system, these externalities are dangerous because, in addition to operational risk, they are fostering also systemic risk. Because given that not only banks, but only the infrastructures that are behind these banks are closely interconnected, a failure on a single system could unleash a systemic collapse, just as it happened between 2007 and 2009. Fear, greed can be transmitted in a matter of seconds. Okay, and given, following the words of Minsky, that we are irrational, that we are subject to greed, to fear, and we identify a signal in the market that is managed by an algorithm based on an unsupported assumption. Probably I will sell, probably I will run to my bank to get my money back, among other things that could unleash a financial crisis. Of course, one of the main regulators, international regulators, is aware of this. And the Bank for International Settlements, the same institution that has set the standards for financial regulation, for banking regulation through the Basel Accords, have also published recently, last year, the draft of their operational risk principles, among which I think that for our purposes, the most important are those that you have on the screen: Principle 2, Principle 4, and Principle 5, that are closely related to the control of these infrastructures. Me as a manager of a bank, me as a banker, me as a technology provider, I have to be able to identify who is the stakeholder behind any application. Just as Principle 4 states, I have to be able to map the relevant internal and external interconnections and interdependencies, because given that we are relying on global value chains, not everything is within the bank, not everything is within the walls of the financial group, but they probably are relying on the infrastructural power held by companies like Amazon or Microsoft, or probably of a coder that has uploaded the source code in GitHub. Because something that the Bank of England has discovered is that many commercial banks and even many central banks around the world develop smart applications based on open source codes. Also, of course, building upon this, we have Principle 5 that says that I have to manage these dependencies and relationships that are within, of course, and outside the financial group, outside the commercial bank, the central bank. So that's why it's important not only to explain what is happening within the algorithm, as we are going to see in a substantial amount of literature on this topic, but also who is behind the chain that is offering us this technology. Okay, and based on this, we have to, of course, foster explainability, identifying stakeholders, avoid machine-to-machine interactions, okay, because that will be the worst case scenario. We work in a world that is interconnected, just as Guido has stated in a couple of his papers, okay, but how interconnected we should be, okay? Can I rely only on sandboxes to test smart applications within our financial systems? And I would like to highlight something here. Yes, sandboxes in practice are very useful. For example, but in the context of not only operational risk, but also on the context or before the risk of a systemic risk, on the face of a systemic risk, I will work also with the terms, particularly of Article 8 of the Artificial Intelligence Act, of the draft of the Artificial Intelligence Act. Because when we read Article 8 of these high risk systems, for example, when we are talking about the introduction of certain applications of certain systems in the public and private sector, there is a numeral in Article 8 that apparently is designed for banks related to credit behavior. Okay, most of the works on financial systems, most of the works related to machine learning and artificial intelligence within financial systems is based on that. And it's okay, it's great. Okay, because if we do not work a proper algorithm for pondering risk, probably we could be labeled as a prohibited system for purposes of discrimination, for example. Okay, it's important. However, that is not the most important risk that we are going to face within the financial market. And I would add to that articulate those algorithms as a high risk system, those that are based on algorithms that could introduce systemic elements, systemic crises. Now, of course, the financial sector is the most famous example, but we could identify other systemic elements, other systemic risks in other industries. And I think that given that we are relying on global value chains and interconnections of interoperability, as it was evidenced in the case of Google versus Oracle, we have to consider, or I would add that element of systemic relevance to that Article 8, and of course work on that systemic relevance in the financial regulations also. Yajon, I don't know I think we are on time. Before anything, thank you very much. And of course, I'm eager to discuss and answer and interact with you through your questions. Thank you.
Thank you very much, Israel. I think we are bang on time. And thank you very much for your talk, which is fascinating. And I actually learned a lot, and then I've been thinking throughout your whole talk. So just like I said, if you've got any questions, please feel free to use the Q&A function of Zoom. If you could put the questions there, I'll collect the questions, and then we can have a discussion with Israel. Although, like I said, before I open up the floor, I would like to have a few comments / questions for Israel, and I hope you will find these comments or questions helpful. So I think I always have this love-hate relationship with artificial intelligence / machine learning or any kind of sophisticated technologies. So in the case of fintech, actually, I've been thinking about whether it's a positive or negative force for our financial market to have new technologies like AI to kick in, right? So, and you've already highlighted some of the potential market imperfection or market failures in the financial sector when AI is playing a bigger and bigger role, right? So what I'm going to do here is to play the devil's advocate. So you mentioned how AI could make things worse in terms of market power, in terms of information asymmetries, and in terms of externalities. Now, I'm going to give you some counter arguments, and I would be very interested to hear your thoughts on those arguments. So in terms of market power, you did mention in terms of the market, in terms of infrastructure power, AI could essentially or could potentially concentrate the power to only a few key players in the market who has the resources to deploy the best algorithms in the market and make the most of the data or information available, right? But the counter argument here could be that as AI or machine learning becomes more affordable and available to smaller players in the market, such as the new banks, right? The smaller online-only banks like Starling or Monzo here in the UK, they could actually make the most of it, and the argument could go that they are actually better off now because, well, thanks to AI, thanks to machine learning, they have more resources than they would have had where AI were not available to them. So you can argue, yes, it's empowering the big players, but they are also empowering the smaller ones. And I wonder what you would think about that argument. In terms of, well, maybe I can just finish quickly all the three counter arguments, and then you can sort of respond
As you wish.
one. Yeah. So in terms of information asymmetries, again, the argument could either be it's making things worse because information is becoming essentially some of the markets have become closed gardens, right? So information is not really available. But if you think about information asymmetries, not just in terms of the availability of information, but also the ability to digest and make use of the data, then AI could be a positive force, right? Because we all know the theories about bounded rationality. People are not fully, or humans are not fully capable of processing complex data or information. And AI can actually play a role in helping market actors to digest the information and then turn it into something that they can benefit from. So from that point of view, we can also argue AI is actually helping the fintech market to function better because it empowers actors to make better use of information. Right? Again, I would be very interested to hear your thoughts. The last bit about externalities, you did mention systematic failure, and I don't think I can argue with you on that. And there are already cases where systematic failure emerged in the market, but also one could argue with more sophisticated, more advanced technology, again, such as AI or machine learning, we could potentially be better equipped to highlight or to flag up early signs of systematic failure. And also, you mentioned it's important to find out who are the sort of, the real players behind the scenes, right? And the argument could also go down the route that actually it's very hard sometimes for humans to follow where the money goes and then find out who's behind all those decisions in the financial market. But with these more advanced technologies, now it's possibly easier to just highlight those bad actors who might be hiding behind layers and layers of shells or whatever schemes or arrangement they have. So yes, so these would be my sort of counter arguments for or my arguments for the for recognizing AI as a positive force in the fintech market. So I wonder what you would think about those points.
Now, certainly, these are fascinating points posed by one of the brightest minds I have had the opportunity to meet, and certainly they are fascinating. Well, I will start first with the concept of externalities and the power of certain technologies to highlight, for example, elements that could help us to forecast, for example, a financial crisis or even criminal behavior. In the context, for example, of money laundering, I have the opportunity to work closely with the Financial Intelligence Unit of Mexico related to the management of money laundering, employing these kind of technologies. And some of the issues that arise in practice is that, yes, the technologies, the algorithms like machine learning highlight a lot of behaviors that are suspicious. However, here we tend to face a problem known as the crying wolf problem, that sometimes people that is not a criminal but something ignorant makes certain transactions, and the algorithm identifies them as something potentially criminal. So for now, in practice, we have the problem to filter this information and to determine which behaviors have the most potential to be actually criminal. So that's one of the challenges that we have, at least in the context of criminal behavior. Now, in the context of financial crisis, if we could get an algorithm that could highlight the signals of a financial crisis, you will be awarded the Nobel Prize among other prizes. Because behind every financial crisis, you are going to find, yes, several common elements. For example, you could argue that shadow banking had been behind most of financial crisis, behind the crisis of Over and Gordon Company, the Brothers of Noiville crisis of 1763, 1866, the Great Financial Crisis. But also they tend to be behind financial innovation and speculative bubbles. Now, just as in the case of the crying wolf problem, we have experienced different periods of instability, of financial bubbles. Currently, we are living one. For example, a couple of years ago, someone was stating in Forbes, in the Financial Times, that given that we were witnessing this big bubble in Bitcoin, we were facing a new financial crisis and nothing happened. So given that the financial markets are based on irrational, I will say, behavior of unsophisticated investors, banks, central banks, is very difficult, if not impossible, to forecast a financial crisis. Certainly, just as you have accurately stated, yes, we could highlight some common elements within the universe of data. For example, we have shadow banking problem here, we have a shadowy financial innovation here, we have small banks heavily interconnected, heavily leveraged, that are becoming systemically relevant. Yes, that could be certainly useful, and actually central banks are working on that. They are not putting that on place completely, but they are working on that to make these kind of forecasts. But we are working on that. And I think my personal point of view is that we are not going to reach a perfect arrangement, but a good one. Yes. In the context of information asymmetry, certainly the name of the game today is big data. Certainly we need machine learning to process this amount of data, particularly in an industry that relies on a lot of data. However, the problem with information asymmetries within the context of the financial industry is explainability. To understand how it works, how it is deployed, and when it fails, how or where it failed. So, and also, which are the risks associated to the deployment of these algorithms on the offering of certain services. That is the line of information asymmetries, but in this point, I concede that given that the name of the game, again, is big data, and the financial industry relies historically on what we could call big data, yes, it's desirable to have these kind of technologies processing this kind of information, despite that we could work on a series of regulations that could address issues related to explainability, not only transparency, but also explainability. And based on the market power, here we have a tricky element, because yes, fintechs are efficient. For example, you said Monzo, but Monzo also has suffered for inexperience. It has suffered several audits by the Financial the Financial Conduct Authority, because it didn't report several activities, it didn't report several sources of funding, that it was leveraged on certain elements. So it's a good product, it's a good services, I will not deny it, but they lack of experience within the financial industry. Also, when you are relying, yes, most of these technologies eventually will become affordable. Totally true, that is a fact that we can forecast. But the problem will be, how are you going to employ that source code, for example? Okay, how are you going to code the understanding of what money is, what banking is? That is a problem, and very few people knows it. For example, if I ask you, all of you, what is money and how could you code what is money? Some of us, we could code it as a medium of exchange, means of payment, store of value, a piece of a message, a sovereign message, uh, a tool for making a currency war. For example, also it will rely on, if we are talking about inside money, outside money, the different definitions of underlying sources of liquidity that very few people can understand. So if you code, if you have access to this technology, but you want to work on it, to offer it to the financial sector, or to develop and offer financial services by yourself, you will have problems. And this is very evident. I will put an example that I know many of you hate: blockchain. Okay, what happens with blockchain in the context of the financial industry? Everyone was stating Ethereum, Ripple will knock out commercial banks. And actually, Ripple eventually said, okay, I will work with banks. What is the problem? Why most of the banks do not use blockchain? And I'm talking about commercial banks, not JP Morgan that works with investment banking. Why commercial banks and central banks are having problems in adopting CBDCs, developing CBDCs, and working with blockchain? Because not even Ripple, Ethereum know how this works. Everyone can have access to the code, the source code of Ethereum. Well, how can you code a perfect solution for the financial industry? That's the problem. How can you offer a solution, an optimal solution for the needs of the regulated financial industry? Because it's fantastic talking about blockchain, decentralization, disintermediation, yes, but you do not need that within the financial industry. You need a tool that helps you to fulfill the regulated activities that you want to offer to your consumers. Okay, so despite that something is available, I repeat, you can download the Bitcoin source code, you can download the Ethereum source code without paying a dime. But could we develop an optimal solution to offer to the financial services? Today, not even the Ethereum Foundation, not even Corda, not even Ripple Labs have achieved that. Okay, the closest example of a success is in China, and that technology was developed within the central bank, not relying on external providers of technology. That's why I think that market power still will be on the hands of those that not will only develop the technology, but they will have the power to offer it in an optimal way to the financial industry. And I think that I have addressed your comments, Johan.
Yeah, that's amazing. And I think I mean, I'm very convinced by most of your answers. Now I do have a few more questions, but I think it's only fair that I give priority to the audience as well as other panelists. So I've got a question here coming up from the Q&A function. So a question from Jay Tai. So the question is, when we talk about AI in fintech, we're focusing on machine learning, or are we actually referring to general algorithms? The understanding is that AI in its narrow sense means some sort of autonomous decision-making based on big data training. And if we should we distinguish these different types of AIs and their implications for the financial market?
Yes, certainly. And here we rely again on the Artificial Intelligence Act. In the case of what we understand as artificial intelligence for purposes of the financial industry, we have to rely on the definition provided in Article 3 and Annex 1 of the Artificial Intelligence Act, that I think is the most accurate for now within a normative instrument in which we have expert programs that work on syllogisms. Probably, personally, I will not label them as artificial intelligence, but we are going to acknowledge that based on the draft of the Artificial Intelligence Act, based on machine learning, and of course, these networks, this third option, Bayesian networks. Okay, so we have these three options based on the Artificial Intelligence Act. For purpose of the financial industry, I will be concerned about Bayesian networks and by machine learning. Expert programs have been a constant within the financial industry, even before and after the Lighthill report. But for me, the main concern is with Bayesian networks and machine learning based on the issues related to explainability. That's the main element, explainability. And if I cannot explain what is happening within a decision or within a financial infrastructure, within a financial product that could be manufactured artificially, I will have a problem, okay? Because if something fails, for example, on the definition of the underlying source of liquidity of a security, probably the entire system could collapse. Probably I will send a signal to the market that something is wrong and everyone will start to sell, everyone will start to, I don't know, fostering bank runs around the world as it happened between 2007 and 2009. Okay, so what I understand as artificial intelligence for legal purposes, I think is perfectly reflected in the Artificial Intelligence Act, expert programs, Bayesian networks, and neural networks, while machine learning and deep learning, of course. And within the financial industry, I will be concerned on machine learning and Bayesian networks, particularly more on machine learning because they could be for interoperability purposes and for forecasts and decision taking. Okay, but I think that that will be the approach that I will take to the definition of artificial intelligence in the sector, within the sector.
Great. Thank you, Israel. And I think that, I mean, you are already talking about the Artificial Intelligence Act, which I think would actually go quite nicely to the next question from Guido. So, so I think he would tend to agree with you with your concerns regarding the risks of AI applications in fintech, but he doubts that any law could resolve all of these problems raised by AI in the sector. But if you could choose a legal change that may improve the situation, what would it be?
Yes, certainly I can agree with Guido that certainly it's impossible to regulate perfectly a technology that changes, evolves. As AI, practically any technology cannot be subject to these kind of regulations. We can see this with GDPR, that every time we are discussing different issues because something new emerged. But if I had to change something, at least in the context of financial sector, it will be the creation of a category of prohibited technologies, just as it happens in Article 5 or the Artificial Intelligence Act. But for example, within the body of regulation, for example, a change in the manuals of the Financial Conduct Authority, in the Banking Act 2009, I don't know, but introduce a chapter of prohibited technologies that, of course, they will have to be paired with explainability requirements that will allow me to determine if this technology is of high risk or actually is prohibited. And of course, I will prohibit not only those that are mentioned in the Article 5 of the Artificial Intelligence Act, but also in this context, I will add elements that could become systemic. Of course, to become systemic, they will have to pose a lot of interoperability. And of course, I will restrict the level of machine-machine interactions and interoperability in the financial industry. In general terms, it's very difficult. For now, I will not have an answer because I will have a lot of issues with artificial. If you ask me about a perfect regulation of artificial intelligence, for example, I will forbid the pursuing of achieving general artificial intelligence. For example, I will be concerned about that. I think Jahon put it that in one of his papers. Is in the Call of Rome, signed between the Pope, Google, Amazon, among other companies. And I agree with that. Probably we should be restricting the efforts of creating general artificial intelligence because actually you do not have a proper application for that, despite the fascinating academic, scientific purposes. Probably it poses more risks than benefits, socially speaking. But I think that that will be my restriction. And yes, I do not have blockchain too, but Every time I try to talk about blockchain in Bailita, in Geeky, among other conferences, I suffer a lot.
I think we all know. Well, many of us who are familiar with those conferences would know it's probably not the most popular term in those conferences. But anyway, I do have a very quick follow-up question, just on Guido's question, and I'm slightly more generous than him, right? So you don't have to change just one bit of the law. If you were able to introduce a whole new regulatory regime to regulate AI and fintech, do you think the best forum to do that will be the AI Act or the existing sort of financial regulation sort of laws or policies, or do you think we actually need a separate fintech AI Act on top of the general AI Act? What do you think would be the best place to put in place those regulatory measures?
Well, following the question of Xiang, I think that, of course, the Artificial Intelligence Act is a good starting point. Actually, several articles of the Artificial Intelligence Act takes you to financial regulations. Now, in the context that you're referring, I will take, yes, the Artificial Intelligence Act for purposes of definition, for example, for some guidance. But I will rely on the work of institutions like the Bank for International Settlements. In the financial industry, given the global nature of the financial industry, we rely on soft law. For example, the Basel Accords that set the basis for capitalization of the banking industry and the pondering of risk, asset allocation, among other things. So I think that a regulation, a new standard prepared by the Bank for International Settlements, working, of course, in the operational resilience principles that have already published. I think that the Bank for International Settlements will be a good starting point to work on a global standard for interoperability for the development, adoption, introduction of artificial intelligence within the financial infrastructure, and of course, to introduce basic measures of pondering risk and control of or setting standards of control infrastructures. But my starting point will be a specific regulation, a soft law that could be issued by the Bank for International Settlements that could be adopted gradually on hard law by every jurisdiction around the world.
That's brilliant. I am just conscious of time, and I'm aware many of us might have more questions or comments for Israel, and I'm sure we can follow up on those points with him by email, or I think Israel is also on social media. So I think by all means, I'm sure Israel wouldn't mind if you want to reach out to him. But for now, I just need to wrap this up and hand it back to Patricia. And thanks very much to everyone from me for showing up in the talk, and thanks, of course, to Israel for the fantastic talk.
Thank you to everyone. Thank you to Yajon for helping me with this presentation. Thank you to Guido, to Patricia, to Sihao, to everyone that helped me and allowed me to present, to give me this amazing opportunity to interact with you. Thank you very much. To Rosanna also. I think she's not here. But
thank you. And I think Patricia is gonna say something, right, for
Yes.
about the next event.
Thank you, Guido, and thank you, Jahong, for excellent moderation. Israel, fantastic topic. I really enjoyed it. And actually, Jahong asked my question at the end about how to approach regulation, something that I'm always interested in, how to handle things without complicating them more. So thank you for asking that. What is left to say for what is my role to say now is actually to announce the next talk. So I'm just going to share my screen. Can you confirm that you can see the PDF that I'm sharing? Great, or the presentation So what we will do next when it comes to enlightening talks, we will skip July in the schedule for obvious reason. Probably we all need a breather to relax and take some rest from this academic year. And we will come back on the 26th of August at the same time from 2 to 3 UK time. And our presenter will be Janice Wong, PhD researcher in computer science at the University of St. Andrews, and the presentation will be on online learning as a commons. What we will focus on is basically co-creation of data protection solutions through a collaborative digital environment. Definitely something that is contemporary and relevant for all of us, given the circumstances in which we have been teaching for the past, well, soon to be almost a year and a half, and probably 2 years altogether once we start a new academic year. So thank you so much, everybody, for attendees who joined us today and asked questions. Thank you, Israel, again, and Jiahong. It was my pleasure to chair this event. I hope I will be joining again in this role or another one. Guido, if you don't have anything else to say, I think we can close for today, and we are perfectly on time.
Thank you, everyone. Thank you also, Patricia, for the sterling job. And see you next time.
Thank you very much.
Thank you very much
Bye.
to everyone.